Hello, welcome to autoregression and moving average models as applied in quantitative finance. So I'm going to be talking about two time series models, autoregression and moving average models. And I'm going to be developing basically heuristics from them for trading purposes, right? To make good decisions. We're going to talk about some of the hang-ups, obviously, right? And we're going to use this quote kind of to guide us how we should look at these models. These are first pass type of models. They're not complex. They're very simplistic in a certain sense, but they are useful, right? So this quote written by George E.P. Box, all models are wrong, but some are useful. I'd like you to kind of keep that in mind while we discuss some of these models. So let's start with autoregression. The clear definition would be AR models predict the current value of a series using its own past values, right? So we see xt is equal to phi xt minus 1 plus error term indexed by t. So xt is the value of time series at time t. Phi is the autoregressive coefficient, measures how fast past values influence the present. Xt minus 1 is lagged value, yesterday's returns. Et is today's error term, right? That's all the factors that are just kind of unaccounted for. We throw it into that error, right? One thing to notice is that phi, it could be ranged from 0 to 1, right? If it's like 0.9, it's basically more persistent. If it's 0.2, it's less persistent and whatnot. And if it's negative, basically it reverts. Okay, and we'll be talking about that shortly. So the basic intuition behind uh, this model is that today's return depends on yesterday's return plus random shock, right? The memory is coming from its past values. Okay, so xt minus 1 in this case. So here's some heuristics. If it's greater than 0, there's basically momentum, right? But that momentum is not forever. It's not going to be climbing up exponentially or whatnot. It's going to decay. So if you look at the first values from like 0 to 10 approximately, you'll see that it increases, right? But then suddenly it decays, and then again it increases, decays, and whatnot. So there will be persistence, but this coefficient basically dies out, and then it just goes in the opposite direction. So I'd like you to keep that in mind. If it's less than 0, it's basically mean reversion, right? And mean reversion in this case means that basically it reverts to an average level. In this case, it's 0, right? And phi is negative 0.8. Previously, we saw that if there's persistence, it's 0.8, which is a positive, right? So in the negative case, it basically has a mean reversion component, okay? And it's not like it's decaying because it's, like if you saw the previous graph, basically it would increase and whatnot, but it wouldn't revert to some kind of mean level, right? In this case, it does. It fluctuates around 0, okay? It'll always snap back, basically, when it decreases, and then also when it increases to the average level. And this basically gives room for trading decisions, right? So if it overshoots and it increases and there's a spike, you could short it. If it goes way, way under, say -2, you could go long and whatnot, okay? So that's the basic ideas. Obviously, these are approximations, and obviously, when you estimate these models on your data set, there could be issues, right? Because it might not generalize well into the future, and you have to look into these issues carefully. Now we're going to talk about moving average. So MA1 expresses the current value of a time series as a linear combination of past error terms, shocks on the current value. So basically shocks are just events that basically perturb the series to make it go up for a while or down for a while or whatnot, okay? It's xt is equal to mu plus error term plus theta 1 error term indexed by t minus 1. Xt is the value of the time series at time t. Mu is the mean of the series. T is the white noise shock at time t. Theta t is the coefficients that measure the impact of past shocks on current value. So the intuition being that today's return depends on yesterday's return plus a random shock. And this memory is coming from its past values, right? So it's the actual shocks that are being regressed on, not the actual value. So it's like error term, right? The stuff that's unaccounted for, okay? Error term t, error term t minus 1, whereas we saw in the autoregression, it was xt minus 1, okay? That was being used. As an example of something that basically persists, for example, in a moving average, is an earnings announcement. So if Microsoft announces something, a positive earnings announcement, you're going to see that basically the stock price will increase, right? The persistence might be stronger. This could be the case. It might not be, right? It's something that you'd have to kind of model in your data and check carefully, right? So an earnings announcement would be an example of a shock. And if we were to like put that in some kind of mathematical form, we could see that basically theta 1 greater than 0 is basically a shock that persists, right? And it's earnings announcements, okay? So that would be heuristic for trading, right? Obviously, also in this case, there will be some decay where it'll go back lower or whatnot. But you could see in this graph, basically, the persistence lasts, whether it's going up or down. Here's another example of an earnings announcement. And it's basically Apple's, there's a headline that basically say Apple's big turnaround, shares erase post earnings drop, right? So like after an earnings announcement, it could drop precipitously and then it could bounce back. Okay, so we see this phenomena in the stock market kind of all the time. And if we were to put this in mathematical form, we could say if theta 1 is less than 0, it will be reversal of yesterday's shock, right? Based on its earnings announcement, right? So if there's a really large drop, you'll always think that it will snap back, right? And that's when theta is less than 0 in the model. So what are the key takeaways? I mean, we started off in this video with the idea that all models are wrong, but some are useful. Okay, so let's break this down. All models are wrong in context. So AR1 and MA1 are simplified representations of reality, right? So we know that they're extremely simple. There's a lot of complex dynamics going on in the stock market, right? So AR assumes today depends only on yesterday's level. MA assumes today depends only on yesterday's shock, which was denoted by the error term. In reality, financial markets are influenced by hundreds of factors: macro events, news, liquidity, investor behavior, geopolitical events, et cetera, right? It's good to note that these simplified models you could use this as a starting baseline into building complex models. But you have to kind of start somewhere. Looking at the behavior of certain series is helpful, right? So both AR and MA are wrong, right, in the sense that they don't capture all the influences. But some are useful, right? So despite being wrong, they are useful for practical trading heuristics. Theta is greater than 0, then you could use it as a momentum strategy, right? If theta is less than 0, phi is greater than 0, you could use it for momentum strategies. If phi is less than 0, you could use it for mean reversion strategies, right? And it's useful for predicting short-term trends in prices, right? I used a model that was indexed by T minus 1, which is like the past day, okay? And that could be useful. It could be 2 days, 3 days, 4 days, depending on how you estimate the model and how many regressors you decide to put in there, right? Based on other factors, but based on other graphs like ACF and PACF and whatnot. MA1 is if theta is greater than 0, it's a continuation of yesterday's shock. If theta is less than 0, it's the reversal of yesterday's shock, right? So I talked about the earnings announcements. And it's useful predicting short-term corrections or echoes in returns. Thank you very much and have a good day.